Good afternoon, everyone. How's it going? AC Fazio, hey Omar, Illinois grain farmer, Carlos, and Tim. How's it going? Good to see you guys. So we started off to a pretty quiet Monday. It was, we can see that we really just like we were saying and we were expecting, we are still within this range that we drew right here. And today we just kind of floated sideways, just barely down. The high was just barely higher than the close, and the low and the close are all within just a very, very narrow range. So not a lot of action today at all. We're still expecting what we were expecting last week. We're probably going to float up and touch this all-time high, and then most likely, as of right now, most likely pull back or chop sideways. There is a chance that we could move higher. A very low chance of us just crumbling and breaking down. So we're just going to count on this just creeping back up, maybe tomorrow or Wednesday, maybe Thursday, tag that all-time high again, and then we'll see what happens from there. But as of right now, it doesn't look like it's going to be super eventful. We don't have a whole lot of catalysts coming up. If we look at our economic catalysts, we've got, hi Peter, hi Ron. We've got tomorrow, we've got CPI. That could be pretty important. Why am I having so much trouble? Oh, this is the wrong week. Let's do this one. A little bit easier to see with it broken out across like this. So CPI tomorrow, that is going to be a well-followed number. I don't think it's going to be far off of expectations. Therefore, there's probably not going to be a big reaction to it. If it is pretty different than expectations, then yeah, there could be a big reaction off of it. But I don't think it's going to be all that significant. I could totally be wrong because that's government data, that's the government statistics. So who knows what they're going to print. And then next Wednesday doesn't look like anything all that important. Then we've got jobless claims and PPI on Thursday. That'll be a little bit bigger. And then on Friday we've got nothing too big or important. Retail sales, that'll be kind of important. So just it was smart to wait today because the whole entire market was waiting, just chopping sideways. So it wasn't a great time to initiate positions. So basically, you've got to think about who has the edge and who's controlling certain markets. If you're going to be playing in the S&P 500 and large cap stocks and even mid cap stocks, Wall Street is in control. They are by far the biggest players and the ones who will determine where prices move. So if they're staying out of the market, then you probably want to stay out of the market too. If they're going into the market, then you want to go into the market. If they're exiting the market, you want to exit the market. That's not necessarily true for the small cap stocks. The Wall Street, a lot less money and a lot fewer institutions can actually play in the small cap stock world. So the small cap stocks don't trade the same way as large cap stocks, and we can't treat them the same way. We can't use the same tools. We can't use the same tactics. So you will see a lot more retail trading in the small cap stocks and especially penny stocks. So you can use the retail tactics on those two particular areas. The smaller they are, the more likely you can use retail type of tools. I'm not a super expert on retail tools. I generally don't pay attention to what the retail traders are doing. So, but I know what's out there. I know what people talk about, what people teach. It's just sort of part of my job is to keep a pulse on what retail guys are doing as well. But for the most part, we really want to, your best edge is with those institutional traders. So if they're not trading, it's a quiet day, you probably don't want to be trading either because they haven't made a decision. Any decision that you make is trying to front run their decisions, assuming that you know what decision they're going to make. So for example, on S&P, it's like, okay, well, why don't we just go long? They're going to take it above the all-time high again. But if they're not putting any money to work, they could easily decide in the other direction. So today, on a day like today, there is no edge to enter. There's no point, unless you're day trading. But if you're going to swing trade, there's no point in entering today because Wall Street wasn't really doing anything with their money. You can see that with the lessened volume, less than average volume right here. And then you can see in the price action, it just kind of chop, so I got a little bit of excitement up here, then came right back down. Then we came back down. We just chopped sideways. And then at the end of the day, we got a little bit of excitement, but then just traded right back up. So just be aware. Don't get too excited. Don't get freaked out. And always be aware, like, whose sandbox am I playing in? So am I playing in the big boy sandbox with all the big, giant, enormous institutions? Am I playing in the medium sandbox? Am I playing in this small sandbox where retail traders might dominate? So you have to use the appropriate tools and appropriate viewpoints for evaluating the appropriate sandbox. You can't take one set of rules and one set of behaviors and apply it to the other one. It just won't work that way. There might be a few things that are crossover, but no, overall, not the same. Okay, so just like you might be good at doing business and suddenly you go to China and you're like, oh my God, the way they do business in China is completely different than what we do in the Western world. So we can't just automatically think we're going to be successful playing by the same rules in a different sandbox. Right? So big boy sandbox, S&P 500, we want to follow what the institutions are doing, and they were very, very, very quiet today. If we look at our gamma this morning, we said, yeah, it was kind of split right here on the S&P. It was a 5-point range, which is not that big actually for SPY. So for it to go up and down, chop back and forth, we pretty much stuck in there in that 635 to 640 region. I'm pretty sure the high, was a little under 639. The low was just a tad below 635. So that range was very good. We ended up closing, and the gamma did adjust throughout the day. Of course, it would have gone a little bit higher over here, a little bit lower over here. We did end the day around 636. So, but it wasn't a different picture than what we saw in the morning. So that's why I didn't put in any updates. So gamma was pretty good this morning. And let's see. Okay, it's going to be hard to evaluate. Like, since Wall Street is really waiting for that CPI number, the best that we can do is maybe look at the Fed Watch tool. But anything else, it's a little bit pointless. If the institutions aren't going to start putting, or they need that data before they start putting their money to work, then we can't really project what they're going to do, right? It's all our normal tools like, oh, which sector is leading, and what is the breadth and all of that. It's largely going to be irrelevant until we figure out what that CPI number is going to be. And then a little bit later this week, PPI. So even though if we get some action tomorrow on CPI, it could get overshadowed by PPI. So if most likely what's going to happen is we'll end up at least reasonably near expectations. And if that's the case, then we're just going to try quietly chop until we get the PPI number, which is a couple days later. So if we get expected numbers on Tuesday, then we can expect probably we're going to chop sideways on Tuesday, and probably we're going to chop sideways on Wednesday, and then we'll see what happens with the PPI number. The PPI number, well, it doesn't really matter if it's good or bad or at the number. At that point in time, Wall Street has enough information for them to put their money to work. So it's not, if the PPI number comes out as expected, it doesn't necessarily mean that we're going to keep on continuing to chop sideways. The only reason why we expect to chop sideways after the CPI, if we hit that number or get close to the expected number, is because we have another unknown immediately afterwards, within a couple of days afterwards. And then after PPI, then people can make their decisions, portfolio managers can make their decisions, and then they'll take it either higher or lower. Okay, so most likely we're going to see a pretty quiet first half of the week. And again, that means it's really hard to take entries right now, well, except for spreads, certain spreads, neutral spreads that capitalize on going sideways. But that's good news for if you're any program that is like cash flow or income or takes advantage of low market movement. That's good news for those types of programs for the next couple of days. And that's actually you're probably the only place where you're really going to get a little bit of an edge in the market over the next couple of days. So yeah, I can look at breadth and I can look at other things, but like I said, until we get the CPI and PPI, it's not too meaningful. I do want to look at gold though, because I keep hearing people comment that gold is moving. And I can show, well, if it's moving, it's not translating into the ETF. Maybe they're talking about commodity. Maybe they're talking about gold spot, but futures, gold futures, gold, I don't know the GC. Yeah, I don't know why people keep talking about gold moving. I guess you had a false breakout on Friday on gold. I don't get it. I don't get it. This was nothing to get excited about. I guess you could say this, but it's too early to get excited about this. Right? I don't see it. We're just chopping. And we'll at some point get squeezed up or down through this, but it hasn't happened yet. Yeah, I don't know what all the chatter about gold is. So we had that example gold trade, iron condor, still doing very well. It's up about 25-ish% as of today's close, still well within that range. So looks like chop sideways to me. Have you guys been hearing that? Have people been talking about gold catching a bid, gold going up, whatever? Trump today mentioned that he wasn't going to tariff gold imports. That'd be stupid to tariff gold imports. Oh my God, that'd be disastrous, especially for our central bank, the Fed Reserve. Yeah. Okay. Hi, Spider Monkey. What happened with today's gamma levels? Did they work or not this time? It worked. It worked, right? We said bounce between 635 and 640, and we did get a bounce. We got a bounce between 634.66 and 639. So yeah, it was pretty close. Yeah. So you guys have been hearing that too? Oh, my speakers just died. Not that I really need them because you guys aren't speaking to me. Hi, Richard. Good to see you. Hope you had a great vacation. Okay, yeah, so I don't know what everyone's getting excited about gold for. It's really just bouncing in this range, and that iron condor is killing it. If it can just bounce in this range for another couple of days, that iron condor will make full profit without any trouble, without any problems at all. Okay, so let's take a look at what else. Since it doesn't make a whole lot of sense for me to look at the market breadth and the market momentum until that PPI number has been released, we'll look at the FedWatch tool, and then we'll see if there's any market neutral type of opportunities we could go into. Okay, based on the presumption that gold will move when speculative stocks drop. Okay, so but that's a lot of anticipation though, right? So number one, you're assuming that if stocks drop, there will be a flight to safety, and so that would imply quite a big drop, right? So that would be beyond this EMA 20 and probably even beyond the MA 50 in order for there to be a flight to safety. And then that's assuming that gold is still viewed as safety at that point in time. And so the reason behind the drop would be important. And also does crypto catch a bid instead of gold? So that would be important to crypto. How crypto is being viewed at that particular point in time is going to be really important as well. There's just too many layers of intent. For me, that's too many layers of anticipation to say like, oh, gold's going to catch a bid. That's assuming that SPY is going to drop too. Also, the general market is going to drop. And yeah, I'm expecting this sideways range movement, but that's not a drop. I guess people would say, oh, that's a drop to the MA50, but that would be normal. It wouldn't be, right, that's a 2.75%, not even a 3% drop. Even this was a 3%. So, I don't know. I don't see it. I don't see why gold is getting all that attention. Yeah. Okay, let's see. So let's take a look at that FedWatch tool, see how things are coming along. We've got an 86.5% chance of the 25 basis point rate cut. So the market is really thinking, but is that down a little? Yeah, it's down a little bit. Even so, market is still thinking that we're going to get that rate cut. That might change after CPI and PPI. So we'll keep monitoring this number. That would be good to watch. And then for October, interesting. So they're pricing in a 41% chance of us having dropped down to basically 25 basis points, and then a 53% chance that there will be basically a second rate cut down 50 basis points from current. And there's wow. So this market, I don't see it, but this is what's being priced in. So this market really thinks that, oh, no, I'm sorry. I assumed that this was still, no, okay. Yeah, 50 basis point rate cut. So 2 rate cuts by the end of the year is basically what's being priced into the market right now. This is actually a chance of an increase, 1% chance of an increase out to December. That's kind of interesting. But 50 basis points, okay, yeah, I don't know. Depending on that CPI and PPI data, I don't want to form an opinion until I see those numbers. Okay, so we'll watch that very carefully. And so let's take a look at where we might be able to look for some neutral trades. In which environment do you think a gamma trade should start getting a high accuracy? We're starting to, yeah. Now is pretty good. So we just need to know if we're in a positive gamma or negative gamma territory. So I found some bugs in the new software that they're doing. So I would just show you that, but let me see if they fixed it yet. Yeah, I don't think so. Yeah, that's not right over here. Okay, so unfortunately I can't show you in the new software. That'd be really cool if we could, but that's not ready yet. Let's take a look in the bar chart software, see if what they're saying. Here we go. All. Did that change? I guess it changed, yeah. Okay, so what you can see right here is that the gamma flip is at 637.44. That means we're in negative gamma territory right now. We're at 636 and change, right? 635.92. So we are in negative gamma territory right now. Okay, and that is that's territory where am I looking? Here we go. Okay. So if we're in negative gamma territory, we're no longer in buy the dip type of environment from a gamma standpoint. These are things that can really run, especially to the downside. These can really run. So, but we're not saying really big gamma exposure below where we are right now, 636. So if we did, then we'd be looking to do short-term bearish, because any movement can just really move. It's just breakouts. This is more of a breakout type of environment rather than a pullback type of environment. So we're not really seeing any large concentrations though. So gamma accuracy will be the shorter, just like with anything else, the shorter term, the more accurate it is. And then, of course, if you see something long term, that exposure can still exist, but it doesn't have to go straight there. It could take its time. It could be a winding path in order to get to that gamma exposure. So the gamma exposure levels are good, and that they absolutely are being operated on, but we won't need to know if we're in a positive or negative gamma. So McDonald's, for example, is in a positive, whereas the overall market is in a negative gamma territory. So we want to be aware of that as well. Each ticker's own gamma environment and how that could be affected by the overall market environment as well. Is this all expiration? No, this is also not all expiration dates. So if we do all expiration dates, that didn't change, did it? Or at least it didn't look like it changed. 305. But last week we were looking at, we were just looking at September. Now this is a pain in the butt. I don't have an easy way to deselect these. Maybe I'll refresh it. And then, yeah, that's a little easier. Okay. Did that even change? Oh, show chart. There we go. Yeah, that 320 is still sitting there on the 1 month level. Okay. So we have a lot of exposure here, but the overall picture still shows 305. So we should move towards 320, but we're not necessarily in a rush to get there because if we go across all expirations, then we're going to get stuck. It seems like we would get stuck at 305. Right now we're at 304.36. So that price is probably going to be a bit sticky. So if we look at McDonald's, yeah, 310, 305. We hit 310, came back to 305. So again, not necessarily a linear path. Right, so we need to consider how far away the exposure is in both in terms of price and in expiration date in order to get better accuracy. Right. And sometimes, so the reason why Gaston is asking about that is in gamma pockets in the past, we only looked at the total gamma exposure. We didn't look at individual expirations, and so. That's one of the changes that we've made to the gamma pockets is that we consider the different expirations now as well. Okay. When do I plan to release the new alerts program? We're not really planning on release the alerts will still be part of the gamma pockets program. It's just the software is going to be newly released. SSD, we're seeing a strong buy signal for SSD from Maverick. Okay, I can kind of see that. So we had some compression going on right here. So over here, it looks like then it came and it bounced it off of that EMA 8. Those are all good signs. And then if you want confirmation, then you go and you wait for that breakout. So this right now would be early entry, and then a breakout above these levels would be the normal entry. Well, not a normal Maverick entry, but a normal entry for me would be for right here. With Maverick, it's saying it's good, then it's tested that it wins at a certain percentage. So we would go and wait for that to, you could follow the Maverick signal. That would be an earlier entry. But because we are in a negative gamma environment in the overall market, we may want to wait and see if it breaks out. Because if it breaks out, it could run. If you follow Maverick, it might just trade you up until the point of breakout and tell you to exit, and then just make a quick little whatever percent that is right there. But in a negative gamma environment, that could just really run, and so you could have a longer term trade or a longer swing trade, not a long term trade, a longer swing trade, and capture even more movement. So let's see. Let's check out the gamma on SSD if they have it. 160.56. So we're in positive territory on Simpson itself. But are they a large cap? Market cap. What is that? 7.5 billion? No, they're a small cap. Okay. Yeah. What I would do if I was interested in taking this Maverick signal would be take the Maverick signal maybe in lots of two, okay? And then when Maverick tells you to exit, you sell half of them or 3/4 of them, and then see if we get a breakout. Right? This is looking pretty good though, very strong. So gap up. And the other thing is was this earnings? Yeah, that was earnings. So normally with earnings, what I want to see is a breakout of the range, okay? And this is encouraging that basically we're forming that wedge pattern. And then Maverick is giving us basically an early signal. So Maverick will probably trade it to the top of this channel or close to the top of this channel. And whereas this does have the potential of actually breaking out and running. So you could try capturing both ways. Yeah. So treat it as, or even treat it as two different trades. One Maverick trade, one breakout trade. Okay, I thought there was another comment there. Nope. Okay. All right, so let's see. I'm well, I was going to say I'm more inclined to do a neutral trade, but then I just remembered the gamma environment that we're in. So this is why we think about the types of environments that we're in. Okay, so I've got my volatility environment, or my implied volatility environment, I have my actual volatility environment, I have my price environment, and then I have my, like you could even do seasonality environment, and then you can even do, and then gamma environment. So a lot of these environments are suggesting sideways chop. And then gamma is suggesting that if we move in a direction, it can really move. So that means that if we break out of this channel, it could really go. So any neutral trade that I did wouldn't necessarily have a great margin of safety if it just runs away. If it just kind of broke out and then pulled back or whatever, then that would be kind of okay, right? We wouldn't expect us to get our faces ripped off. But in a negative gamma environment, if it just breaks and runs, then that'd be really bad for our neutral trade. So we got to be very careful about this. So in that case, rather than a completely neutral trade, what I'd be looking for is a little to no risk to the downside trade, or I should say upside trade if we're talking the direction of risk. So I lose if it goes down, but I make money if it goes sideways or up. Okay, so we're looking at most likely a debit call spread, bull call spread, and with a little bit of leeway to the downside because we are expecting that it could chop sideways as well, right? So we would want to give it a little room. So this is more of an income style trade. Which one looks better to me lately, Ethereum or Bitcoin? Hi, Steven. Let's see, BTC, USD, ETH, USD. The no contest, Ethereum. All right, so Bitcoin looks like Ethereum a couple weeks ago, right? So if we do this, right, Ethereum was stuck in this box, and then last week it broke out of it. But if we look at BTC USD, okay, it's still in its box, and it's been going on for a little while. So yeah, Ethereum definitely looks better. It's definitely stronger. So you wait for a pullback, which it looks like it could do. Wait a couple days, it might just chop sideways, meet that EMA 8 and then take off, or it could pull back, but based on these two last bars, it looks like it's just chopping sideways. Okay, so let's take a look. Let's see if I can find a directional vertical for income. Okay, so what do I look for in a directional vertical for income? The first thing I'm going to look for is a strong trend and something that is strong relative to the S&P 500. So I'm going to go over here to my stock vector. I'm going to look at my sector scan, but I'm not going to look at the sectors. I'm just going to use that same scan to look for individual stocks. And I'm going to do ones that are that have weekly options. Okay, so we'll start there, and I may narrow. Why is there only 25? That's weird. Let's see if we can get something a little bit better. Yeah, my weekly. So weird. Why is there only 25? Let's get all of these. There we go. That's a little better. That was a weird result earlier. Okay, so a couple under these. I want to see a nice clear trend. So this was maybe the beginning of a reversal of a trend. So I don't want something like this. And even Oklo that pulled back a little too far, I just want to see something as smooth as possible. And maybe I don't find one like that, but this is pretty close. It went up, it just went a little parabolic there. So this due for a pullback, which it looks like it's starting to today. So that's not an ideal candidate. But if we could take this Palantir before this last week of trading, then that would have been a nice candidate. Hood is pretty good. Went up, then chopped sideways, and then is now looking like it's about to continue. Hood is pretty good. It's not perfect, but it's pretty good. So take a look at. I'll note Hood. GEV was looking great until it started chopping sideways, but sideways isn't too bad for us. So, and actually you might get paid a little bit better. I'll put on GEV for now. Dash, reasonable. I had this little spike and then come out. I wonder if that was due to earnings. Yeah, that was due to earnings, so I'll avoid that for now. Just something really nice and smooth. Newmont. That's interesting. It's looking pretty good. It's gold, mining of precious metals. Interesting that it's doing so well while gold is chopping sideways. But I'll throw it on the list a little bit. GE is looking good. Just that nice steady low volatility. Look at AVGO. That looks beautiful. That's probably the best looking one so far. I probably don't even have to look any further than that, actually. BK is looking really great also. All right, we'll run with those two. Let's take a look at BK. Yeah, that is looking very nice. And then let's look at AVGO. Yeah. Okay. Let's see if we can just see how liquid their options are. Neither one should be an issue, but if I look at BK, And say I would have preferred Monday to Friday, a 1 week trade. If I do tomorrow, still Tuesday to Friday, I guess that's okay. Let's take a look at this. It's really wide. I wonder if that's just after hours. That's unfortunate. Okay, let's look at AVGO. And that was the monthly expiration too, so better. Not wonderful, but not bad. Okay, so we can probably do something in AVGO. Let's see if we can get anything worthwhile on a 1 week trade. Okay. And we want a little bit of cushion because the overall market, we're saying, could still pull back. Even if it's trading in a sideways channel, we are near the top of that channel, so it could start heading back downwards. So we would want to give ourselves a little bit of cushion. That's why it's income style, not speculative style vertical. So EMA 20 would probably be pretty safe. Let's see, it's 8.75 ATR. Let's take a look at our 1 ATR targets. Yeah, 1 ATR doesn't even, or we're more than 1 ATR away from the EMA 20. So let's see if we could get paid anything. Probably not for just 1 week, but it's worth a shot. About 192. Oh, so 292, sorry, 292. All right, 292 and a half, let's just say. 290, 292 and a half. $55 on $1.95. That's actually not too bad for 1 week. Oh, dollar. 28% for 1 week. If we got into this tomorrow, that'd be 7% per day. That is super lucrative. I'm kind of surprised that you can get it that good. All right, well, I like it. Now remember, these are just, trade examples. So if you decide to trade, you trade at your own risk. This is not an official published trade or anything. So, but this is looking really good. All right, so I'm going to save this 290, 292.5, and then you would want what Jack Carter likes to say, a tripwire. So if it falls below a certain dollar point, you just decide that you're going to get out. And one way that you might do it is just say, okay, I like to give you guys different ways. I don't like hard and fast rules. I know that a lot of people like those simple and hard and fast rules, and they're great for beginners. But my goal is to educate you to become a better trader. And a Wall Street trader is constantly evaluating things. You got to be quick on your mind. You got to be able to evaluate these things. And as my mentor told me, you have to get a feel for it because we can't always calculate so quickly. So you have to be able to get a feel for it and get an instinct of understanding on how each type of trade moves and what affects it and how it affects it. And so you can make a quick decision, but then go back and validate and verify that your thinking and your instinct about it was correct. So for example, that if we said, oh, let's just pick a level that below that level, we're just going to sell it. Okay, great. And you might say, okay, well, my max gain ends at 292 and a half. And so maybe I'll do 293, 294 and a half, maybe even 295. And if it falls below that, I'll just exit. Okay. But if tomorrow which is Tuesday, just say end of day. Tuesday, end of day. Okay. Tomorrow we went down to 295, you would lose 26%. If you're Wednesday, if we went down to 295, okay, you'd lose only 16%. And then if you're Thursday and we went down to 295, we'd still be at a loss at 13%. And then Friday, by the end of close, of course, you'd be making 100% profit or 30% profit, right? You make your max profit. So if you set that style, what you need to understand is that on such a short expiration, that such a drastic move, even though it stays in your max gain zone, it's going to make it so that if you decide to close it, you're going to lose. But if I'm in my max gain zone, time is my friend. Okay, so even though it looks like I'm losing right here at 294 or 295, it looks like I'm losing 29%. If I just wait, as long as it doesn't keep on going lower, then, if I even wait all the way till Wednesday, right, I'm still losing almost the same amount, only improves by a few percent. And by Thursday, though, it's improved quite a bit. I only lose 5%. And then sometime on Friday, I go past that break even, and then I make the maximum gain. So time is my friend. So you don't want to stop yourself out too early, right? And so in my opinion, the way I would trade it is I would set my stop out value a little lower. And as time goes on, then I would move it upwards, if that makes sense. Now, a lot of people, they would have the opposite instinct. They would say, okay, well, tomorrow at the end of close, at the end of the day, you would say, okay, well, my break-even point is over here at 302. So if it falls below 302, I'll just take a small baby loss. And then on Wednesday, I can move that further out. And then Wednesday by close, I can move that down to 299.74, which is only like 25 cents. Okay, so it'd be kind of pointless to move it. And then Thursday, I can move it all the way down to 297. So that's a couple of dollars I can move it. And then maybe on Friday, I could just move it down to 292.5, 292, so that I make a baby loss. But if you do that, it makes it a lot easier for you to stop out. So it just depends on which approach and which angle you want to take it from. So personally, I like to start out a little bit lower and then move my way upwards. But if I'm in my max loss zone, time is working against me. So at any point in time in the trade, if it enters into my max loss zone, I'm just going to cut it immediately. So that's where I would define my first point right there. Is my first point is, okay, if it hits 290 at any point in the trade, then we're absolutely out for sure. And then let's let another day pass. Just say we're at Tuesday, end of day, and I might move it up. Okay, well, if it goes down to 291 or 292, I'll be out. And then another day passes, I'll move it up again. Okay, this curve is looking pretty good. Maybe if it moves down to 293, then I'll be out. Okay, and then after that, I've already pushed myself into my max gain zone. So I'll redefine it since there's only 2 days left anyways. As long as we're in my max gain zone, I'm just going to wait it out because time is my friend. But then if it dips below my max gain zone, then I'll go ahead and stop myself out. So that's a more dynamic way of setting where your stop point is going to be in these types of trades. Right? The other thing that you could do is the equal move ratio. That's how I showed you guys in the previous trade, the equal move ratio. So at what point is the reward risk no longer in my favor? And that's the point where I'm going to say that's my absolute stop out point. Okay. Do you need me to go over the equal move ratio again? Or you guys remember that? Yes, this trade I'm showing you is a bull call spread, yes. Let's see. Help me win an SPX call spread with your gamma. Oh, excellent. That's great, Kay. That's great to hear. It is because of after hours, your XLI was showing a profit of, yeah, you can't treat the mark or the P&L that your broker reports to you as real. You just can't do it. It will give you the wrong answer. The wider your bid-ask spreads is in each of your legs, the more wrong that value is. So the only time I ever look at mark in my brokerage, well, basically I don't, but I never look at this. Oh, where'd it go? Okay, I would never look at the mark or the P&L and try to and treat that as a real number. So basically, if it's not a real number, why am I even looking at it? So therefore, I completely ignore it. Okay, so the only time when it's okay to do that is when the bid-ask spread is really tight, within a few pennies or 5 cents, maybe 10 cents. Okay, that's the only time where it's kind of meaningful. Every other time, it's just completely meaningless to take a look at those things. So don't do it. You're going to get the complete wrong idea of how your trade is performing. Right? That's what I call false prices appearing real. I've done many videos on it, talking to many people about it. Just ignore that mark, ignore that mid price, ignore that P&L on your screen unless your bid-ask spread is really tight, because you will get the wrong idea and you'll get excited for no reason, you'll get depressed for no reason. And there was a kid during COVID who didn't understand that, and he thought that he went hundreds and thousands of dollars. He owed hundreds of thousands of dollars. It was because of a mark. It wasn't even a real price, and he ended up killing himself. He shot himself. He died because he didn't understand that the mark was not a real price, that this P&L is complete BS. Okay, so I think it's a huge disservice that brokerages report this. The only reason I keep it up here is because I teach and people look at it, and I have to show them all the time that it's fake. Okay, and all of my personal accounts that I don't show you guys, I completely remove these columns. I don't even look at them. They're so wrong. Okay, so don't get deceived by that mark or the P&L. Okay, and I wish someone properly educated that poor kid, because if you get the wrong idea, you get super emotional and then you do stupid things. Don't listen to the mark or the P&L at all. Yeah, this trade right here is a type of spread. Okay, so there are many types of spreads. So let's see if I go to option strat, it lists not all of them, but it lists many of them. Okay, so these are basic long puts. Okay, and then we have credit spreads, we have debit spreads, we have neutral spreads, we have calendar or diagonal spreads, and then we have butterflies and condors. Those are also a type of spread. Okay, so there's a lot of different types of spreads. A spread is defined by I'm buying and selling. So I buy and I sell, and usually of the same type. So if I buy a call, I sell a call, that's a spread. I buy a put, I sell a put, that's a spread. Okay. If you buy a call, buy a put, that's not a spread. That's a strangle or a straddle. Or if I sell a put, sell a call, then that same thing, that'd be a short strangle straddle, okay? So if you buy a call, sell a call, or it doesn't matter how many of them, any combination of them. So if I buy two and I sell two, if I buy, two of the two calls and then sell three calls and then buy one call, okay, that's still a spread. Right? So if I have a combination of buying and selling calls, as long as I have they add up to the same number of contracts, that's a spread. If they don't add up to the same number of contracts, then you have a ratio. Okay. When you release your gamma leveling tool, will you give us lessons on how to use it correctly? Yeah, absolutely. Absolutely, I will. AVGO regularly touches the EMA 20. Yeah, it does. So as long as it doesn't break the EMA 20, then we're fine, right? If we set our level at that EMA 20, 292, okay? So here it touch, bounce, touch, doesn't quite touch, touch, bounce, touch, bounce. It never closed below the EMA 20. Right, so I think our level is pretty good. You're talking about the 15, that's 295. Yeah, irregular touches, yeah, 295. But I don't care if it touches. I care if it closes below on a Friday of expiration. Right, so based on this, even if I change this to 15, I don't know if you're using the MA or EMA, okay, but that level is 295.27. Then my 292.5 is even safer from that perspective. So, but here, I guess we never closed below the EMA 15 either. So if you wanted to be a little bit riskier, you could move your, if based on that, you could, if you wanted to be, if you trust that EMA 15 more than the EMA 20, and you're very confident about it, then yeah, you could. Did I not save that? Where did it go? Where's that option strat? I guess oh, here we go. Okay. Yeah, if you're like, okay, I'll do 295, 292, 295, and I can make it even better profit, then go for it. if you're happy with that. But I'd rather be a little bit safer and be down here. Okay, you wanted a review of the EMR. Okay. It is not a credit spread, it's a debit spread. So right here we have debit. So we're paying out of pocket to get into the, and then when people tell you that a credit spread, you get paid to go into that's a complete mislabeling or incomplete understanding of what actually goes on, because if you design this as a credit spread, okay, we could do the exact same as a credit spread. Okay, and we would have the same math basically on it, except for whatever reason, it's a lot more expensive to put on the credit spread than it is the debit spread. But assuming they were priced the same, then the math on them would be the exact same. And you're like, no, I get paid up front to go into the trade. Okay, but your broker will charge you the margin, right? So it's not the same as getting paid up front for it. You don't get utilization. So for example, if I did this trade right here, yes, I collect 36.5, and yes, my initial cash balance will go up by 36.5, but my margin and my buying power will go down by $213.50. You see that? So I don't get utilization of that $36. I can't then go trade $36 worth of stuff because I was deducted $213 of buying power. Okay, let's just make these prices easy. Okay, let's just make these easy just so I can compare apples to apples. Okay, So I 50, so $200 max loss, $50 max gain. You know what? Let's do this. Okay, so we go. Sorry, I did that wrong. Okay. $50 max profit, $200 max loss. $50 max profit, $200 max loss. So these are priced the same, and mathematically and behaviorally, they're the exact same. The risk profiles the exact same. But what happens here is I pay my $50, right? And I get deducted that $50. Okay. And then if you really want to be real about it, then yeah, well, the most I can lose is that $50. Okay. So sorry. This is the credit. Am I messing this up? This is the credit one. Okay. So I will be charged that max loss. So my buying power will go down by $200. Here I'm paying $200. So of course my buying power goes down by $200. Okay? Unless I'm on margin and then actually only goes down by $100. So actually I have a slight advantage over here, but let's forget about that for now. Okay. So let's just say I don't have a margin advantage, meaning they don't lend me any money to go towards my trades. Okay. So it's just my pure cash balance. So here I lose $200 of buying power. Here I lose $200 of buying power. The fact that I collected $50 doesn't mean I can then go and do another $50 of trades. It doesn't mean I can take that $50 and withdraw it from my account, because they're reserving the worst case scenario, which is I lose $200 on the trade. Okay. So there's no advantage. There's no advantage of going into a credit spread. There's no, okay. So it's a misconception. All right. So I like debit spreads in 99+% of cases. There are a few rare cases where I will prefer a credit spread, but in most cases, I always do debit spreads. Okay. Yeah, Omar, send me an email. I'll be happy to answer your questions. Okay. Okay, thanks, C. Fazio. How will this DR spread make money? I'm not sure what DR spread stands for, but in this case, if AVGO stays above 292.5 by expiration, then you will make the full profit potential, which is a little bit actually less than, it was about a little bit more, depending on exactly what prices you get. So we made it a little bit more expensive for ourselves. It was priced at like 297 or 295, 195, 197, 195. But in any case, if we actually got in at $2, then we could make a maximum of $50, which would happen as long as on the 15th, the AVGO closes at or above 295. Okay, it could happen before expiration if AVGO just skyrockets to like $350. The market maker might allow us to close it for full profit before expiration, or if we're willing to give up $1 or $2 and close it several days early, that might be worthwhile as well. Okay, so that's how it makes profit. As long as it stays at or above 295, it will make the full profit of $50, which would be 25% on your risk. And then as long as we're above our break-even point, which is 292, so for each penny above 292 that AVGO closes above, then you'll make $1, up to, of course, a maximum of $50. And so that's how this trade makes money. Glad that was helpful for you. Got you. Okay, DR is debit. The first time I've seen that. Interesting. Okay. CR maybe is credit. Okay. This is buy to open the 290 call and sell to open to 292.5 call. That's correct. Yeah. August 15th expiration. That is correct. Yeah. Okay. So let's run through the. Oh, I'm ran out of time. Well, I'll just save this trade, and tomorrow we can do the EMR, okay? So should I put it in at this 50? Yeah, why not? I'll just handicap ourselves a little bit. I don't know if the market will move at the open or not, so we handicap. We just assume that you could get in at $2 rather than the 197, I think it was, that it was pricing at. Okay. All right, cool. So we'll end it there, and we'll continue our EMR evaluation on tomorrow's session. All right. Have a wonderful rest of your day, guys, and I'll see you all tomorrow. Bye, guys.